What's up, guys? Got a good video for you today. I'm going to be analyzing the metrics that I look at before investing in a stock. I'm also going to rank these. If you disagree with the rankings of these, disagree with me. All right, I'm a youngin', got much to learn. All right, let's get into it. For most investors, the PE ratio is probably the go-to metric to look at before investing. It stands for the price to earnings ratio. This metric is important to see how expensive a stock truly is. The larger the PE, the more valued or hyped this company is. The lower the PE, the more undervalued or slept on the company is. Now, the normal PE ratio differs across industries, but it's important to know the average PE to make sure that you're not overpaying for stocks. It's also important to note that the PE ratio simply does not math out for companies who are not profitable. The equation just simply doesn't work. Additionally, the PE ratio is not indicative of companies who are growing fast, as their strategy may have high capital expenditure and thus decreases the earnings, which skews the metric. And that is where the PEG ratio comes in. The PEG ratio? I'll let you guess. What does the G stand for in the PEG ratio? That's right, growth. This metric is calculated by taking the price to earnings ratio and dividing it by the annual earnings per share growth. No lie, guys, this is one of my most looked things. Some people call it the holy grail of value investing, and I agree with them. Using the price to earnings growth gives greater understanding on the forward momentum of the company, and not just the company's current state. When I invest into a stock, I expect them to grow, right? Therefore, every single time I look at a stock, I need to know the PEG ratio. The rule of thumb is that if a stock is underneath 1, it's undervalued. And that's so easy to remember. It takes maybe a minute to check. It's quick, it's easy, it's the price to earnings ratio, S tier. Next up, we have past performance. And I always hear all the time, past performance is not indicative of future returns. I hear it, but I think there's not really a whole lot of truth to that. Doesn't mean that we should outlaw previous performance data from current investing theses. Theses? I don't know how to say the plural of that word. Regardless though, I think every investor should look at the past history of the company that they're investing into. It gives us a wider view of the company. Seeing its stock price relative to the quality of the company at that time gives us a better understanding of the patterns and growth potential. I think this allows investors to gain greater insight and, give smarter estimates on where the company's headed. Like the age-old saying says, you gotta know where you came from to know where you're headed. I'm gonna put past performance in C tier, maybe change it up to B tier. I don't know, we'll see. Next up is revenue. Now, before saying anything, I just want to differentiate between net revenue and gross revenue. Gross revenue is all the money the business brings in without any deductions. That means, yes, the money they've made from stock sales counts as gross revenue. Now, net revenue is a metric that accounts for deductions and losses in 3 areas: returns, allowances, and discounts. Net revenue is definitely more accurate in determining the core business health, but there's still some spending that net revenue just doesn't account for. I'm going to put revenue in C tier. Next up, we got the net profit margin. Net profit margin is something I always look at before investing. I think it's one of the most important metrics. But the key thing is got to be net profit margin, not gross. Net profit margin is the profit they've made after settling up all the expenses. The cost of goods, the marketing, the debt. This is the money left over. And guess what? In the stock market, newsflash, guys, the goal of a company is to make money. Therefore, believe it or not, when net profit margin is high, usually the stock price is high. I will say, though, that the caveat to this metric is that if a company's spending a lot of money on capital expenditure for the sake of growth, the net profit margin will be skewed. I'll put the net profit margin in A tier. Next up, we got share buybacks. And oh boy, everybody's got an opinion on this. It used to be illegal. They were considered a tool for market manipulation due to the fact that a company buying their own shares drove up the price. Now I'm going to tell you here, determining if share buybacks is an indication of good business can be hard to tell, simply because the people on the board of directors, the executives, the C-suite people, the bigwigs, whatever you call them, all right, they have every incentive to authorize share buybacks. This means that they have a personal financial incentive to see that the stock price rises, and share buybacks are an easy way to make this so. However, in some cases, cash spent on share buybacks would be much better used to improve the business. The tricky part is it's difficult to tell if management is buying shares for selfish pursuits or they genuinely think it's a smart business decision. On a different note, a company buying back shares at the right time can increase their profits, and it shows to investors that, yeah, the company believes it'll grow, believes that buying back shares now is a strategy for the long term. My thesis when it comes to this is to look at the stock price, look at the free cash flow. If a company's stock is low, but that cash flow is high, then yeah, it's a smart decision to do buybacks. All right, I'm kind of torn whether to put this in C or B tier, but we'll put it in C for now. Now, the next one up, CEO's previous performance. CEOs are the figurehead of a company. They're the one person chosen to represent the sum of the company's parts. Many times, CEOs were an executive at another company, and the idea is by looking at CEO's previous performance, you have the ability to reflect and see the strategies to see if those were effective. Well, I'll just say the thinking is kind of flawed. Different company situations means different strategies. The logic applied to one company may not even work with another. Instead, the value in looking at the CEO, in my opinion, is in 3 simple questions I ask myself. Number 1, Does the CEO clearly communicate his goals in a shareholder letter? Number 2, in the past experience, did the stock price rise? And third, is the CEO paid with stock options? So why are these 3 questions important? Well, the ability for a CEO to be clear and concise with their goals in the shareholder letter is a sign of his communication abilities. If they can't elaborate on their strategies in a pre-planned document, they definitely aren't communicating with the internal side of the company the route and strategies that need to be taken. Now, number 2, the stock price rose in the previous company. That's just a quick and easy signal for me that the CEO did their job. Number 3, if the CEO is paid in stock options, that tells investors that, yeah, they're more likely to advocate for strategies that benefit the stock price, and therefore my position alongside with it. I'll put this one in C tier. Next up, we've got industry performance. Now, seeing how a company ranks among its peers, for me, is pretty important. By seeing the industry as a whole, and not just taking a look at the one stock you're considering buying, you're getting a better view of the trends happening inside the industry. You can see what companies are doing well and what companies are doing poorly inside the specific industry and identify what factors made this happen. Now, number 1, this allows for better predictions to be made. Number 2, the cause and effect you learn can be applied in future use in different industries. I believe comparing a stock with its industry performance makes you a better investor. I'm going to put industry performance in A tier. Next up, we've got retail versus institutional stock holding. Now, data shows that stock prices fluctuate more when it's primarily held with retail investors. Knowing the retail versus institutional investor holdings allows us to predict the price volatility. The larger the retail investor percentage, the more likely I am to wait to see if the stock will drop. I don't think this has ever affected my investing thesis, but it's allowed me to secure a stock purchase with a lower price. I think the logic of this is a little bit flimsy, so I'm just going to put it in D tier. But moving on, we've got EPS, earnings per share. This is an important metric. It's calculated by taking the net income, subtracting by the dividends the company offers, then dividing that number by the number of shares. So why is this important? Well, a high EPS is an indicator of how profitable a company is. I think that's pretty straightforward. If you're looking for a stable company with decent growth, look at the EPS. See if that number is growing. But the issue with solely looking at the EPS is if the company is spending large amounts of money in capital expenditure. If management thinks CapEx is what the company needs to grow, the EPS metric is going to be shot. The net income will decrease and the EPS with it. A lot of companies, when entering a high growth phase, have low EPS. I'm going to put earnings per share in A tier. Next up, we've got analyst ratings. Now, these give us a consensus opinion on the quality of the stock. The whole job of an analyst is to take an in-depth look into a stock and evaluate whether it's a buy, sell, or hold. I like this method. They do the hard work, and they give us an opinion for free. But I do get a little skeptical when it comes to these. Most of the times, these analysts are nameless and faceless. And you can't tell me that corporations aren't paying these people to sway their opinions. I would not be surprised if some of these analysts get bribed. Regardless, though, it's a free tool that I look at most of the times before I pull the trigger on a decision. B tier. Moving on, we've got EBITDA. Now, what is the acronym? Well, it stands for earnings before interest, taxes, depreciation, and amortization. Accounting class has drilled this acronym into my head, and for good reason. It's a good metric to assess the company's condition before their financials get muddled by any of the accounting BS the company wants to pull. I will stand on the fact that depreciation is a cheat code that accountants use to make the business appear more favorable. Looking at the EBITDA gives us a greater transparency into the health of the core business. A tier. Next up, we've got free cash flow. This is the money left over after a company pays all its capital expenditures. This extra cash can be used in so many different ways. Paying dividends, adding to cash reserves used for future use. It's very versatile. Not to mention, free cash flow shows the health of a company. Chances are if a company is performing poorly, they're not going to have very high free cash flow. That's not to say that this is the case all the time, but in the cases where free cash flow is not accurate in showing the trajectory of a company, that's when the company may be growing really fast. In this case, it's going to spend a lot of money and free cash flow is going to go down. We see this in the case with startups. Uber, for example, only had positive cash flow starting in 2023 and it IPO'd in 2019. But during that time, the stock price rose. So I would say free cash flow is a good indicator when used on an already established company. Last but not least, we've got looking at insider transactions. I believe not a whole lot of retail investors use this statistic. The US government mandates that all stock purchases are made public, which allows everyday people to see who's buying and selling and at what amounts. If you invest on a trading platform, usually a trading platform submits these documents for you without you having to do anything. So that's why this metric slips under the radar. Having transparency into this information allows you the chance to identify certain traders who purchase with patterns. For example, if you see Berkshire Hathaway purchase a stock, you can assume that they're going to be holding for a long time due to the decades-long pattern of repeated holds. So by visualizing what certain traders do, you have the ability to basically copy off their homework. Large institutional investors are going to analyze a stock way more in depth than you ever will, and chances are they're going to be educated with their decisions. The caveat is, public transactions can be up to 1 month delayed. The thing is, a stock price can change a lot in 1 month, so you're not getting their exact investing thesis. B tier. Once again, guys, if you made it to the end, I just want to say thank you. Me and Sadie put a lot of hard work into this video, so if you made it to the end, do me a favor, hit the like button. Alright, otherwise, have a great day.